Thank you for viewing this video. We would like to start off by giving a quick thank you to our annual sponsors. Our gold level sponsors, Geronimo Properties, Transin, Northmark, AEI, May Property Management, and Mansar. Our silver level sponsor, St. James Real Estate Advisors. We would also like to mention our charitable partner for 2023, New View Communities, a CDC organization promoting affordable housing in central Massachusetts. To find out how you can become a sponsor of the New England CCIM chapter or to learn more about New View Communities, please visit our websites. There are links in the video description below.
Okay, welcome to New England CCIM's first event of 2023. My name is Lisa Don Francesco, and I am the founder and principal St. James Real Estate Advisors. So please be sure and check out our calendar of upcoming events for additional educational programs and activities. I'd like to welcome our guest speakers. We have Eric Gashin and we have Jon Nelson, and they will be introducing themselves in a minute. Thanks to Eric Shabshelowitz, Cabot and Company. He's a program committee member, coordinated the speakers for today. So let's begin with Eric and Jon. Thanks so much.
Thanks, Lisa. Good morning, everyone. As Lisa mentioned, my name is Eric Gashin. I'm a partner here at Walter Shuffain. Been here for 23 years. I work out of the Boston office. I spent a lot of time in the real estate space. For future reference, my contact information is on this next slide. So my contact information is there. I'm going to let Jon briefly introduce himself.
Yeah, I'm Jon Nelson. Happy to be here today. I've been, with the firm now for going on 8 years. My entire career, I'm a manager out of the Boston office, and just like Eric, I spent a significant amount of my time in the real estate space.
Thanks, Jon. Just a little more information to share about ourselves and the firm. WS Walter Shuffain, we're a mid to large size regional firm, approximately 90 people. We have 11 partners. We're headquartered downtown in the financial district. We have a second office down in the South Shore in Westwood. The firm's been around for 60 plus years. About greater than 50% of my time is devoted to the real estate space. I work with groups of real estate clients that include both entities, for example, partnerships, corporations, trusts, a bunch of individual work. Often extends to families and executives, managers within real estate groups. Specific to real estate, including ourselves and our firm, we assist real estate clients in all different capacities. Just to name a few, we work with developers, managers, operators, brokers, etc. Work in retail, office, multifamily, mixed use. Over the last 10 to 12 years, we've developed a special niche in the private equity real estate space, and that's become a huge part of our practice. So basically clients raising capital and deploying it all over the country, some of it local, some of it, throughout. We obviously handle the tax compliance side of things, but when things can we really can provide value is on the planning, the consulting side. Acquisitions, dispositions, refi, like-kind exchanges, real estate property contributions, tax and accounting, financial statement work, audit reviews. We kind of do it all. Also assist with due diligence processes. We'll get into some of these detailed areas in this presentation, but just wanted to give a kind of a high-level overview. Jon, did I miss anything?
No, I think you did a good job. I think I just mentioned one other thing. People think of this as just as tax season items, and although, and that's not really true. We deal with real estate and our clients all year round. And this goes way beyond, traditional compliance work that everyone thinks of, which is basically just tax prep. We really are able to provide value to our clients by staying up to date on the latest tax changes, as well as what's going on with our clients throughout the year. It's the work and conversations in between the actual compliance deliverables that really makes a difference for us.
Well said, Jon. Some high-level topics we're going to cover, a few just administrative issues. Disclaimer I have to put in here, this material has been provided for informational purposes only, is not intended to provide and should not be relied upon for tax, legal, or accounting advice. You should consult your own tax, legal, and accounting advice before engaging in any transaction or taking any action. As was mentioned previously, we're going to take some questions throughout as time allows. So agenda items we're going to touch on are up on the screen. Some of these areas can get a bit technical, so we're going to keep things as simple as possible for our discussion purposes. Please note answers and advice can change significantly based on facts and circumstances. So once again, it's important to reach out to your own professionals to make sure things would apply to you and would not apply to you. A lot of the tax deferral strategies we're going to cover today accelerated depreciation, like-kind exchanges, 1031s are tailored to real estate held for investment or rental real estate. So some of these items won't be applicable for everyone in the audience. I'm now going to turn over to Jon, who'll briefly discuss our current tax environment.
Thanks, Eric. Relatively speaking, there hasn't been a lot of significant tax changes recently, specifically for tax years 2022 or 2023 that are really specific to the real estate industry. There are some smaller items that will work back in time through that we think are relevant for our discussion today. So just to basically set the table and provide some backstory. Most recently, the Inflation Reduction Act, or IRA, which passed in August of 2022, included a few minor tax components. Applicable to the real estate industry was the significant energy-related credits and incentives, mostly focused on adopting certain environmentally friendly technologies for both businesses and individuals. The most applicable in general to the real estate industry was the sweetening of the 179D Commercial Buildings Energy Efficiency Tax deduction, which enables business owners to claim a tax deduction for installing qualifying systems in buildings. The tax deduction is available to owners of new or existing buildings who install interior lighting, a building envelope, which is typically considered the foundation, roof, walls, windows, and doors. Also, heating and cooling, ventilation, or hot water systems that meet specific minimum energy requirements. This deduction has been around since 2016, and as a result of the IRA, the potential credits available increased from $1.80 per square foot all the way up to $5 per square foot. The new increased credit per square foot is for property placed in service between 1/1/2023 and 12/31/2032. So Congress provided us quite a bit of a runway for developers, property owners, etc., to utilize these incentives. The other core piece of the IRA was an increase in IRS funding for enforcement. Tens of billions of dollars will be available to be used over the next 10 years by the Treasury Department and IRS. It will be interesting to see how these dollars are spent. There were some statements made that there wouldn't be increase to historical audit percentages for income tax payers under $400,000. Although what happens, remains to be seen, but I'll just leave that one at that. Before the IRA was the CARES Act, which was most known for the PPP loan, employee retention credit, and other COVID-related incentives. For the real estate industry, the most important item may very well have been a correction of a drafting error from TCJA related to the timing of the deductibility of qualified improvement property, QIP, also known as TI or tenant improvements. This fix in the act allowed retroactive write-offs or bonus depreciation on certain qualifying property that, per the drafting error, was not bonus eligible and was written into the legislation with a depreciable life of 39 years, therefore making it not eligible for bonus. As a result, we were able to go back and claim this depreciation expense for our clients for preceding years. And finally, a few years before the CARES Act, TCJA pushed a lot of the classic real estate incentives into overdrive. Always a highly tax-efficient industry was only compounded by the new laws that took effect with TCJA, the largest set of tax changes implemented since 1986. The primary focus of this act was substantial changes to bonus depreciation, which we'll talk about in the next few slides. Bonus depreciation can shelter taxable income, which provides opportunities for tax-deferred cash flow. Real estate in general provides many opportunities for tax deferral strategies, basically kicking the can down the road if the can is your tax bill. These deferral strategies play directly into a wide range of estate planning opportunities, which Eric will cover later on in this presentation. So that was a quick update, on what the current tax environment is. How did I do, Eric?
Did great. The only thing I would add is just the last point on here, and this is very current for people here in Massachusetts, is the new Massachusetts surtax, which is the new 4% tax that's tacked on to the existing 5% tax for any income earned over $1 million. There's been a lot of talk out there. This is definitely a hot topic. We don't yet have final regulations, so there's some questions out there in terms of interpretation. What I've read about most recently is, people coming up with situations where, if you have a married couple filing separately, does that give you the opportunity now to take advantage of $2 million at the 5% versus $1 million? I don't know if, if this loophole is going to get closed. I don't think it was the intention, but it is out there. And so it'd be interesting to see what happens over the next few months. Although not completely tax related, we thought it might be helpful to share a few observations of the economic environment we're seeing with our real estate clients. Increased interest rates are taking a hit to cash flow, especially on new acquisitions, but valuations have remained largely consistent for the time being. I saw a huge shift from where we were 1 year ago today. Q1 2022 was similar to 2021, but then things slowed down dramatically for the remainder of the year. People still have the wait and see attitude. As more debt begins to mature over the next year or two, it's going to be interesting to see how that affects investment decisions and lending. Lease cycles maturing in commercial space likely to show the true effects of the new hybrid work from home policies. People were locked into leases when COVID hit, but many companies need to, are forced to decide now where to go from here. We'll see the true economic effect on the economy once fixed debt becomes due over the next few years. And that'll be quite interesting because so many people have locked into these low fixed rates. How this will affect cash flow and lending decisions, could have higher vacancies. I'm seeing many of my larger multifamily clients get creative, in some cases utilizing recourse debt, allowing for lower interest rates to get cash flow a little higher. Obviously, this needs to be, the right property, the right situation. So, it's not a situation that works for everyone. I'm also seeing clients look at deals outside their traditional business models to continue growth through the interest rate cycle. Typical my A minus acquirers are now looking at B and C properties as a value add. Current environment is a substantial change from the cheap money period we've been so accustomed to, where valuations have been off the charts and refis and supplemental loans at rock bottom. They pumped tremendous amounts of additional cash into the marketplace. Some of it's distributed out to partners, some of it's retained, put back into properties. But we've gotten so accustomed to this. Pretty recently, we started to have conversations about TI. For the last few years, going back to 2018, TI and free rent effectively had the same tax implications. But now, as bonus depreciation is sunsetting, it does have a different tax impact. So, this is a discussion that's pretty relevant and current. So it's, it's quite, I think it's going to only continue as this year goes on into next year. Jon, do you have anything to add?
No, just, to echo, the sentiment on, the cycle of leases, someone could have, any private company could have entered, into a lease shortly before COVID. They could be locked in, for 10 years and they could still have, 3, 4, 5 years left on that lease. And so, until this lease cycle really ends and, and private companies work through, their work from home and hybrid policies, we're really not going to see the true effects of vacancies, until, people are up to make all these decisions and all of these leases have turned over. We could see a situation where there's, more commercial vacancies than there currently are now. And then you combine that with maturing debt, it's going to be a really interesting situation, to see what happens and unfolds over the next couple of years.
Yeah, I think the maturing debt is quite a concern. So, everyone's locked into these low rates. So it's going to be a huge impact, I think, to the economy, over the next few years and beyond. So it'll be interesting. We'll see what happens with the rates as well. I'm going to turn it over to Jon to talk a little bit about depreciation and depreciation.
Thanks, Eric.
Yeah.
So basically, just to kind of, start at the very beginning, when you purchase a property, typically, for us especially, typically one of the first items we work through is the land and building allocation. The building portion allows you to establish and determine your depreciable basis, which is basically the amount that you'll be taking deductions on. The default is 27.5 or 39 years, depending on the underlying use of the property. There are certain square footage thresholds for mixed use space that can push an entire building to 39-year property. Once you've established your depreciable basis, we can now explore the benefits of cost segregation. Cost segregation, in general, is an engineering study conducted by an engineering firm that breaks out a property or your building into several categories with differing useful lives, typically shorter useful lives. Some examples of property you can carve out are personal property and land improvements. Personal property typically covers movable property like appliances, equipment, furniture and fixture cabinets. But for cost segregation, personal property can also include certain types of electrical items and plumbing items with specific auxiliary uses. Land improvements cover sewer systems, storm management systems, sidewalks, pavement, fire hydrants, fences, guardrails, to name a few, and various types of different landscaping items. The goal is to categorize as much as possible into these different buckets, thus reducing the amount allocated to the building, your longest useful life, and default depreciable period. Certain assets uncovered or carved out by a cost segregation study are eligible for bonus depreciation, meaning you can immediately expense X percentage based on current law in year one of acquisition. Bonus depreciation changed significantly under TCJA to include prior use property, meaning assets that were previously depreciated by the prior owner. When bonus was first introduced, it was only for brand new property, a brand new piece of equipment, newly constructed real estate. It did not include a building that you purchased from someone else that had already been placed in service and depreciated at any degree. TCJA increased bonus depreciation to 100% beginning in September of 2017, but the percentage has fluctuated over time through various different congressional acts. Throughout the end of 2022, bonus depreciation has remained at 100%. Beginning in 2023 and beyond, it will decrease 20% a year and will be completely eliminated for 2027. It's important to understand the differences between cost segregation and bonus depreciation. For example, if bonus depreciation didn't exist, you could still complete a cost segregation study and depreciate your identified personal property over 5 years. You just wouldn't be able to write it off all in year one. We also wanted to point out that the bonus depreciation is typically only available for federal tax, and most states do not recognize bonus depreciation. However, there are a few states that do recognize bonus, and some have quirky add-backs that investors should be aware of and should always be researched from state to state as part of your due diligence process. Any thoughts here, Eric, as I kind of work my way through?
No, I think that was great. I mean, I'm a huge proponent of accelerating depreciation where you can. But I think you also have to keep in mind, these are timing differences. If you take a lot of depreciation up front, there's always you're going to have a less depreciation down the road to offset your income. Potentially, there could be some phantom income down the road when you start paying back principal on your debt. The more you plan, the more you can, map it out, the better educated, the more you can, see what the future impact will be to you. But as a general rule, a deduction today is better than a deduction tomorrow.
Thanks, Eric. All right, just to circle back on bonus and accelerated depreciation, these substantial ordinary deductions are great up front. They can be used to shelter rental income or other income in certain situations. And then when you sell, the gain associated with the sale will typically receive capital gain treatment. So in summary, ordinary deductions up front, providing benefits at higher income rates, and then lower capital gain rates on the potential disposition. Next is recapture considerations. Accelerating depreciation is not without downsides. Depreciation in general comes with recapture considerations and can lead to a portion of your gain from the sale being taxed at a higher rate than standard capital gain rates. Basically, to the extent that your gain is driven by depreciation you have taken on the underlying property, that portion of the gain could be subject to a tax rate of 25% or even ordinary rates depending on the type of property sold or broken out in a cost segregation study you performed. Personal property would be subject to ordinary income rates at the time of sale, and real property would be subject to a 25% tax rate, but the true appreciation realized in the sale would receive favorable capital gain treatment. You should note that recapturing capital gain portions of the sale will reflect the sales price allocated to each underlying property, which can change from sale to sale. Since recapture does lead to exposure at higher rates, bonus depreciation may not be a great option if there is a potential sale or recapitalization in the years shortly after taking these deductions, especially when a taxpayer might not have the insight into their future tax situation or the tax situation of other investors or partners. A lot of the time, our concern with taking bonus on a short-term home stems from the situation where a taxpayer is taking bonus, reaping large ordinary deductions in year one, and using those deductions to offset capital gain income in the same year. This isn't necessarily the best use of those ordinary deductions. If you fast forward to a potential sale in the next few years after acquisition versus, a long-term hold, you would be subjecting yourselves to recapture at higher rates. Then your front-end deductions, because you didn't use the original bonus depreciation as a true ordinary deduction, to offset income at the highest marginal rate. Any thoughts here, Eric? The recapture piece gets pretty complicated pretty quickly.
Yeah, it does. And once again, it's probably some of it beyond the scope of this presentation, but, should be looked at, on a case-by-case basis to determine the impact. And, if you're going to buy a property, you're going to hold it. Generally, the cost segregation makes sense. Generally, you want to accelerate. But, if you only want to hold it for a year or two, well, it becomes more complicated as far as what you want to do. So the next topic, just want to touch on like-kind exchanges, otherwise known as 1031 exchanges. Like-kind exchange is more popular now than ever before, certainly in my practice. Going back to in histories, like-kind exchanges were on the chopping block back in 2017 with TCJA. There was all sorts of lobbying going on the Hill, but it did survive. The key difference between pre-2018 and post-2018 is the portion or what we call personal property, no longer being able to go through a tax-free exchange. These are pretty common with planes, vehicles, and other types of personal property. We used to see them quite frequently, but those are no longer allowed, under the new like-kind exchange regs. So you're limited to primarily real property, specific here, real estate. So it did survive, which was a huge win for the real estate industry as a whole. I'm sure most people in the audience have heard of like-kind exchanges. However, I thought it'd be helpful just to share some of the basics. What is a 1031 exchange, a like-kind exchange? Those are interchangeable. The 1031 exchange is a real estate investing tool that allows investors to swap out investment property for another and defer capital gains that you otherwise would be subject to at the time of sale. This method is especially popular with investors looking to upgrade properties without incurring taxes for sale. There's a few different types of 1031 like-kind exchanges. There's what's called a simultaneous exchange. That's when you do it at the same time, you exchange one for one. There's a delayed 1031 exchange, which is kind of what the most common, probably about 75% of the exchanges that I see. And that's typically when you sell a property, you have 45 days to identify a new property and then 180 days to close. There's the opposite, which is called the reverse exchange, where you actually would acquire a property first and then sell. These get a little more complicated and quirky, but certainly it can be done. We've seen a bunch of those. There's also what's called a construction or improvement exchange, and that's where basically you're selling a property and holding aside some money for construction purposes within a short period of time. Like-kind exchanges, they provide the ability to swap, upgrade real estate tax very efficiently. You can defer income and tax associated with the sale of property. It's an extremely powerful tool if you're trading up. I probably see at least 10 of these transactions a year amongst my clients. Quite common, and it, once again, to reiterate, very powerful tool. It's very unique to primarily the real estate industry. There's not a whole lot of other industries that sees a benefit like this. As I mentioned previously, personal property is not allowed for a like-kind exchange. It can't be included. So as such, we've seen a few of our clients actually carve out personal property out of their relinquish and replacement properties of the exchange and recognize a gain on the relinquished portion, the sale side, and take additional depreciation on the replacement on the buy side. If you're trading up with additional debt or cash boot, this can be very beneficial with bonus depreciation incentives as long as they're still on the table. Effectively you can create a nice deduction, even though you're doing a like-kind exchange. Just something to keep in mind, a warning, reducing debt or taking cash off the table needs to be contemplated, because cash proceeds or even reductions of debt could trigger a tax implication. So you need to be very careful with these exchanges and really need to plan them out.
So we have a couple of questions on the 1031 exchange.
Sure.
Okay, this is from Mike Carey. Do the speakers have any opinion on the optimum length to hold a property? And then he also goes on to say, I'm sure it depends, but from a pure tax standpoint, what's the best minimum amount of time to hold a piece of real estate when considering depreciation and other tax implications?
So those are two different questions, I'm assuming. It's a very gray area. And this question comes up quite frequently. What I would say is you need to demonstrate the property was purchased for investment purposes and not to flip or not for personal reasons. And the more documentation you can have to support that really can make your case. If I were to throw out a number, I think certainly a couple of years would look great on paper and, pass the sniff test. But, there are cases, it's kind of, in fact, case specific, but it can be less. But it's really, documenting the intent. In other words, if you're raising money from investors and you have a memorandum that talks about your intentional hold period, something like that, I've seen that used to really take a position as the investment purposes. It's really your intent. It doesn't, it's not just a blank year that you can use. The second question, can you just repeat that?
Sure. It says, I'm sure it depends on the time, but from a pure tax standpoint, what's the best minimum amount of time to hold a piece of real estate when considering depreciation and other tax implications?
Yeah, it's a loaded question. John, I'll let you take this one. Give anything to add up front or?
Yeah, sure. I mean, so I mean, just to be clear, when we purchase, a property, like we have to take depreciation. If it's getting used and it's getting rented, it has to be placed in service, and the depreciation clock needs to begin. And so depreciation in general, it doesn't really, matter per se for a number of years, in general, where the time period really comes into play is when you decide to make bonus decisions, and whether or not you're going to take bonus, whether or not you perform a cost segregation study and things like that. And usually, if it again, it depends on facts and circumstances. It depends on, the individual's underlying tax situation. But basically, in a general sense, over the short term, a couple of years, you run the risk of getting burned on a tax shift, basically, so if you took significant, deductions in year one, and, for example, if you're a real estate professional, and you use that to offset capital gain income, you're really only getting, basically the equivalent of a capital loss, and that just depends on your underlying tax situation for that year, and then if, 2 years later, you don't necessarily know what your tax situation is going to be, and, you have a lot of ordinary income, you basically could be shifting capital gain deductions to ordinary income deductions over a short period of time. And if that's going to be the case, then bonus depreciation, cost segregation, and those things like that, like really start to not make sense. But again, it's a case by case basis, and the short term hold is really when those two elements really need to be investigated and discussed and looked into and planned accordingly for.
John, just to your point about depreciation, it's required. It's not like it's an optional thing you could do. It's allowed or allowable. So if you don't take it, the IRS could come back and say you didn't take it. That's your problem. At that point, it's too late, and you need to adjust your gain when you sell it because you should have taken it. You didn't take it. So we've seen that. There's a lot of case law out there on that. So just to make sure everyone's aware of that. Going back to just finishing up on the 1031 exchanges, there's some alternatives to 1031 exchanges if it's not a good fit for you that allow some of the benefits of a 1031, but you don't necessarily need to do a 1031. I just thought I would highlight some of the things we're seeing. And the first one is, pretty obvious. I'm sure most people have seen it. It's, your traditional cash out financing. It allows you, to pull out money, especially on appreciated property. Although in this current rate environment, especially, if people are locked into the existing, low rate debt, effectively you can pull money out virtually tax-free. However, the thing that always needs to be considered is the ultimate, where that cash, that extra proceeds are going, because that will determine the deductibility of that portion of the interest. I'm kind of oversimplifying, but as a general rule, if you take a bunch of money out and you go buy yourself 10 Porsches, that interest is not going to be deductible because that's personal. But if you take that money or you acquire a new building, you go out and you put into the stock market, that's going to be deductible under different classifications. This is what's called investment interest expense. You could deduct it as, property interest expense. So there's all these, different considerations there. Other things our clients are doing in terms of selling and liquidity events, there's the ability to make tax-free contributions of property to another partnership, that has existing property, for instance, and you could, you would take a percentage ownership based on value. And this can be done on a smaller scale or a larger scale. I had a client recently who did this with a publicly traded REIT, was able to convey his entire office park into a publicly traded REIT as a tax-free process. It's called an UPREIT, and there's opportunities there, and that these work great if you want to diversify, quite frankly, if you don't want to deal with the management of your property anymore. So there's all sorts of creative things that can be done in terms of property contributions. Another thing that's become really common, especially in the last 5 or so years, is a 1031 via by way of a tenant in common interest, also known as a TIC. We've seen this extremely tax efficient and successful transaction. It can be contributed back to a master partnership after a period of time. So basically, if you have a property and you want to kind of partner with an existing group, You could sell your property, acquire a portion of a new property, and it would be like a tenant in common interest would be a percentage interest. So if it's 50%, you would own 50% of that building. The other party would own 50%. You would own 50% of the mortgage. So it's almost like there's a line right down the middle. So you would have two independent pieces, which allows for the 1031 exchange. You can't exchange into a partnership interest. That's the key difference. But you can do a tenant in common interest. And ultimately, the goal can be to merge these all together. So then you have one partnership down the road, under common management, and you don't need to keep them distinct. It's a great tool. And we've seen a lot of this. I think I mentioned this already, but diversification, a risk standpoint, you can be involved in more properties as opposed to one property, less liability depending on the entity structure. So it's been a pretty big win, both on a lot of, for a lot of our clients, both on the selling side and then for the larger group that they're going to acquire into. So, John, anything to add here?
No, I would just echo that. The 1031, to a tenant in common, ownership interest has really, has taken off. Especially lately. I see so many of those in a given year, and really they stem from, a family has one or two, three, a handful of kind of legacy assets, and they're old, the mortgage, or not old, but they've had a really, really long term, hold there. The cash flow isn't as great, their mortgage is pretty low in the grand scheme of things. So when they, when you send your money off, to the qualified intermediary for a 1031 exchange, there's some significant opportunity to lever up and, really upgrade your property. And also if you're ready to hand, the keys to someone else in terms of in the management agreement, a TIC agreement, it's a really great option, so you can have less headaches, if you will, and, improve your cash flow. And it comes with, some pretty good diversification side as well.
So we have a couple of other 1031 questions for you. So this is from Wayne Spiegel. What strategies work for partners that don't want to 1031 exchange together, convert to a TIC? How long after TIC conversion can one sell?
Yeah, can you repeat the first part?
Sure. So he's looking for strategy. Yeah, sure. So he's looking for strategies that work for partners that don't want to 1031 exchange together. And then it says convert to TIC. How long after the TIC conversion can one sell?
This is where things get a little dicey, and maybe more of a conversation kind of offline. There are ways and methods that people can go different ways that currently own a property together in a partnership. They aren't without risk per se, and the timing on the back end of it to move on to that piece of it is definitely something that could be scrutinized, and again is probably best discussed kind of offline. Facts and circumstances help, timing helps, and certainly lapsing a tax year, straddling tax years and things like that definitely improve the facts and circumstances, and how this looks on paper.
Yeah, there's no silver, there's no answer there that's like, okay, 2 years or 3 years or 4 years, or it's very facts and circumstances. It kind of needs to be evaluated, and someone's risk level too. We need to, you'd have to have the discussion in terms of how aggressive they want to be, and the IRS could take a position to challenge it, and what's their comfort level. So
okay, thank you. 1031 is a popular topic. So another comment actually from Michael Chase. He says 1031 is great. Ultimate tax strategy: defer, then die.
Yeah, I mean, that's the whole. We're going to talk a little bit about estate planning, so we'll get to that in a sec, how this plays into the estate planning move. But you're right. I mean, you defer. Effectively, you can wipe out, all of this negative capital that's been created as a result of, these excess cash flows from the debt. And, you'd be subject to an estate tax, but from an income tax perspective, it's extremely efficient if you die with it. But there are estate considerations for sure that need to be taken.
I also have a question. Based on the current market, we have low product inventory. I have a client who will be putting property on the market soon. When would you recommend that we go out to the market to begin looking for property exchanges?
Probably before.
Yeah.
I mean, you have 45 days, to identify a property after you close on the sale, but it's quick. it sneaks up on you. And usually, when we see what we see with our clients is, they really have a potential deal that they've, at least signed, like a preliminary agreement on, kind of like in unison. And again, they have, 2 or 3 solid, leads that they would be acquiring anyway. And, depending on, how large they are, like what their portfolio looks like, they could be planning to purchase a property straight up cash, and basically swapping, those opportunities back and forth in those acquisitions. But yeah, I mean, we see it well in advance, or, at least simultaneously with it. It takes a long time, for lending and due diligence processes and things like that. And there usually does any acquisition, come with it any couple of hangups like here and there, so it's better to be, earlier the better, I guess.
And I would add we've seen a bunch of reverse 1031 exchanges, which is the opposite of your traditional 1031 exchange, because people have found the property they want to buy, but we're more worried about finding something to buy versus selling. So we've seen quite a few of those reverse 1031 exchanges more recently than we had in the past because of that.
Great, thank you.
Sure.
All right. So one of the few negatives to TCJA, specifically for the real estate industry, was a business interest deduction limitation that was passed. So these limitations were aimed at limiting the business interest expense deductions of 2 main groups of peoples or entities. One being large businesses, and the second being businesses that generated losses, think real estate with depreciation. Specific to these entities that generate losses, they target businesses with a significant percentage of passive investors or limited partners that do not play an active role in the day-to-day operation of the underlying properties. Large businesses are typically defined as those with greater than 27 million in gross receipts, but the amount is indexed annually for inflation. Now, the 27 million isn't a hard and fast rule. There are all sorts of complicated attribution rules where an investor or family, common ownership, would be required to calculate their percentage of gross receipts across various entities to see if this limitation might possibly affect them. It is not a simple process, and is not as easy as looking at one entity at a time. It's a cumulative gross receipt test on an individualized basis. Specific to the real estate industry, interest expense after depreciation might be one of your largest expenses that you might see in your P&L. So maintaining 100% of interest expense as a true cash deduction can provide significant tax savings depending on facts and circumstances. One solution that TCJA passed was what's called a real property trader business election. Basically, what it means is if you're in a real property trader business, you operate and depreciate rental property for a living, that you can make what's called a 163J or ADS election, and you are able to take 100% of your interest expense without limitation. And that sounds great, right? But what's the catch? Because there always is one. Under a real property trader business election, that entity in this case would have to adopt alternative depreciation system, or ADS, versus normally what's called maker's depreciation. All this really means is you will need to depreciate your property over longer useful lives than what you would normally have to. Under ADS, a residential property is depreciated over 30 years instead of 27.5, and a commercial property is depreciated over 40 years instead of 39.5. This increase reduces your annual depreciation expense per year, since you're spreading a fixed amount of depreciable basis over a longer period of time. Now, this reduction in annual depreciation expense could be far less than the limitation on interest expense. In practice, we see a lot of our clients opting for this trade-off and leaning in favor of being able to deduct all of this interest expense. Eric, do you have any thoughts on this one?
I think, no, that was great. My only thing to add is just at a high level. I mean, I think for folks in the multifamily arena doing, business in the residential space, it's a bit of a no-brainer because the only thing you're losing out on is 2.5 years, extending depreciation for 2.5 years on the real property piece. You'll still get a bonus on the cost tag, personal property. So it's a no-brainer. When we start talking about commercial, office, retail, it's a little bit more of a discussion and planning, because this does limit the ability to take bonus depreciation on tenant improvement property, which is a big one for a lot of commercial landlords. And it has been a discussion, although with the sunsetting and the changing of a 163J, it's becoming more and more appealing to make this election and to take the extended depreciation to be able to deduct all your interest expense. I guess also increased interest rates, so you're paying more interest in a lot of cases too. We're seeing most of our real estate clients and that are subject to 163J are making the election these days. I just want to touch on some estate planning items that I thought would be very relevant for the real estate folks. Before we get into some of the estate planning, updates and what we've seen in regards to estate planning, I want to disclose we are not estate planning attorneys. I would highly advise reaching out to an attorney in conjunction with your CPA before moving forward with any kind of estate planning. Just high level, what's going on in the estate world. Federal lifetime exemption increased for 2023 from 12.06 million to 12.9 million, which would mean it'd be approximately 26 million for a married couple, certainly the largest in history, the highest exemption in history. Also, the gift tax exclusion increased from 16 to 17,000 for 2023. If you're married, this would be double. That's the amount that you can give without it being considered to be a taxable gift or something that's reportable to the IRS. Mass exemption remains at 1 million, which is the majority of these states that we deal with. And, likely this is going to increase. It was last year, it went to the state legislature to increase to 2 million. 1 million is an extremely low number for, if anyone owns a home in Eastern Massachusetts, you're pretty much going to be in that $1 million threshold. So estate planning, although you may not be subject to the 20, 25, 26 million level, a lot of people are subject to that $1 million level. So estate planning is real here. As Jon will mention next, that the estate planning exemptions will be going down with the sunsetting of TCJA. Real estate offers a number of estate planning opportunities, but the biggest benefit is the step up in basis at death with no recapture of negative capital, or simply put, tax losses or distributions exceeding your tax basis or not taxed for income tax purposes. Legislation over the past few years, which threatened to tax real estate as a deemed sale, which would have reversed this position. However, this never happened. It's pretty unlikely to happen in the current state in Washington for at least the next several years. Other opportunities to reduce taxable estates, as far as getting value outside of your estate. There's always you can gift partnership interests. We see that quite a bit. The huge advantage here is you can discount the value for various discounts. You need a valuation done though, but there's some great opportunities to discount. I mean, you can give the minimums, you can make a real gift and file a gift tax return. Other things that we see interfamily sales. It's another way to utilize discounts and lock in today's value, so you could sell it at today's value. You do need to consider arm's length here. A real valuation needs to be done, but you could sell with a promissory note, effectively using distributions from the properties to pay back the promissory note. Interest rate is, you can use the AFR, the applicable federal rate, which is typically pretty low. It's up from where it was, obviously, like everything else in, with interest rates, but it's still a pretty decent number. Often we've seen these notes can be interest only for quite a period of time. We've seen this mechanism used for years and pretty successfully. The last thing I wanted to mention in the estate world is something that's become quite popular, what's called an intentionally defective grantor trust. This is one of the more common estate planning tools used by our clients more recently. The intentionally defective grantor trust allows for an irrevocable trust to be created that is intentionally defective. Simply put, this trust allows for a gift for the estate tax purposes, but not a gift for income tax purposes. All income and or losses will flow to the grantor while they're alive, but this is not includable in their estate. So that's a huge thing. None of this would be included in terms of valuing the estate at death. For someone with a lot of taxable income, the grantor can continue to pay the tax, so reduce their estate. Or on the flip side, for someone with a lot of losses, depreciation, they can benefit and retain these losses over their lifetime, even though the real estate is no longer includable in their estate. Certainly a lot to think about. There's plenty of tools here, but certainly you need to bring in, an estate planner in conjunction with a CPA to figure out what makes sense in your, specific circumstance. Jon, any thoughts here?
I mean, we've seen a lot of activity, with our clients over the last, 2 or 3 years, really taking advantage of these increased, thresholds and, some of these tools. The intentionally effective grantor trust is a really, really great tool. maintaining the tax characteristics, continuing with losses. And then even on the flip side, if it's taxable income every year that you're paying, and you're paying it on behalf of your trust or, whatever vehicle, it's basically like a gift every single year, that doesn't really count, for gift tax return purposes. So if there's anyone, that is kind of hungry to make a gift and utilize this exemption, the clock is ticking on it, because, under current law, it is going to go away, or it's going to be, almost cut in half. We've already touched on bonus depreciation, and so just to back up a little bit, these are the sunsets, TCJA, that we've been, dealing with for about 5 years now, and they're about to be phased out. They're going to go away in the next couple of years, so we thought we'd just highlight them. Bonus depreciation is going to sunset beginning, in 2023, 20% every year. It's, and then it's effectively gone in 2027. As we just talked through, the lifetime exemption is set to be cut roughly in half, for 2026. We don't exactly know where it's going to fall and end up. It's supposed to be around $6 million, per individual, $7 million per individual, but we don't really know exactly, because these, amounts are indexed for inflation every year. The top rate of 39.6% is going to be restored, up from 37% under current law. The standard deduction is going to go back, to pre-TCJA amounts, about in half again. And then this might be music to, people's ears, but the $10,000 hotly, contested SALT cap is going to be eliminated again. Mortgage interest, debt deductions is going to go back up to $1 million. It decreased to $750, for TCJA. And charitable deductions based on taxable income are going to drop 10% down to 15%. They're currently at 60%, and have been, 100% for a few years as a result of the CARES Act. So it's kind of, shifted over time. And, the last thing here, is the 199A deduction is going to be eliminated, come sunset, which is basically a 20% deduction on pass-through income, with all sorts of, income thresholds and limitation for wages and, unadjusted basis and things like that. So these are basically, the ones that come to mind, for Eric and I and, our firm as we're moving towards the last couple of years of this act. We never know what will happen time and time again. Congress doesn't like taking away deductions. It's not necessarily, the best look to constituents and things like that. But in summary, some of these could be extended, but only time will tell. These are just some high level items that are set to expire if no further action occurs. And, it's always the best policy, for planning, to just assume that these things are going to happen and not rely on extenders or anything like that. All right, Eric, anything to add? Or I think we're about wrapped up, from our presentation.
Yeah. No, I think I'm good. That was really it.
Thank you so much, Eric and Jon, for presenting. I know I learned a lot of information that'll help me. Thanks again for your time.
Thanks for having us. Appreciate it. And if we can be of any assistance, please, our contact information was in the slides, or you can find us online, our bios. So,
Okay, thanks everyone.
Thanks everyone.
For attending.
thank you. Enjoy the rest of the day.